Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I'm your host, Juan Vargas. Today on the show, we have Alina Trigub. Alina is a syndicator and founder of SAMO Financial, where she has helped her clients diversify and invest in over 1,100 multifamily units, over 500 storage units, and in a $5 million mobile home park fund. She's a former tax accountant at Ernst Young and has an MBA in finance and management from Rutgers University and a Bachelor of Business Administration and Accountancy from City University of New York. Based in the great state of New Jersey, welcome, Alina.
Hello, everyone. Hi, Juan. Thank you for having me. My name is Alina Trigub, and as Juan mentioned, I'm a former tax accountant with Big Four experience. By the way, it was a Big Five in my time, but who counts years? I later switched to the technology world to become the liaison between business and technology professional. And this field made me realize that we are, for the most part, working with other people. So if you want to achieve anything at this world, having a full understanding of how the relationship gets established and maintained is absolutely critical for success in any kind of profession or business overall. With that in mind, and with the personal problem to diversify out of Wall Street, I started my journey of finding a way out of the stock market. And this has been my concern for many, many years. And I've been looking at various things, doing my research, and I couldn't find anything that would make sense to me until I started going deeper into real estate research and came across syndications. And when I came across syndications, I started out originally as an equity partner, investing in someone else's deals and checking it out for myself, kind of how the deals work, what are the syndications about, and what kind of returns I'm getting. And as I've been going through it for the years and years, I realized that this is a strategy that could benefit a lot of other people. Not only that it allowed to preserve wealth, it also allowed to save on taxes. And in addition to that, it offered some residual income for the lifetime of the asset. So with that in mind, I started my own company with the goal of helping other people to diversify out of Wall Street and go into real estate investments. So that's how SAMO Financial was born. And I always promote that as a place where people first and foremost are able to preserve their wealth, save on taxes, and then get some residual income overall.
Yeah, that's really good. And what you're doing here is you're basically helping others. I mean, at the end of the day, that's what you're doing. You're helping others who wouldn't have access to these deals. And what you do, you have access to a lot of deals, and you're able to kind of put the puzzle together and get them into a quality investment with a quality operator, and help them to diversify their funds, right? They're away from the stock market or wherever place that they're at. Okay, so I really like that aspect of it. So that is your focus, but why not? Let's kind of backtrack a little bit. Why not do your own deals,
Sure.
Alina? Because I know you're helping others. You're basically what you're doing is you're raising capital for deals, and why not do your own deals and operate your own deals? That's a question that a lot of people are going to have, and they're going to be asking. They're wondering why not just do your own thing.
Sure. No, that's a great question. So when I started out, I actually have gone into a deal with the plan to be doing everything, and I've done that. However, as I've been going through syndications deeper and deeper, I realized that where the most significant demand is within human capital, and that involves not only raising capital but also dealing with investors, marketing the deals to investors, whether it's existing or brand new investors, depending on the SEC rule that's used for syndication. And that's what I decided to concentrate on. It's sort of like the real estate itself. You try to concentrate on the area where there is a demand, so you bring the supply in. So one of the highest demands is on building the the investor base
Mm-hmm.
and helping deal sponsors raise capital. And that's where my main concentration has been. Not to say that I will not be doing my own deals down the road. That's the plan. I plan to do my own deals. But as of now, in addition to working full-time and having family, raising kids, I'm also working on syndication, so that kind of stretches my bandwidth and puts me in a position where I don't think I can handle more. But the plan is down the road to definitely do my own deals, partner up with others once I find the partners that I want to work with, and do things other than raising capital, managing investors, and managing the overall human capital.
Yeah, that's a very good viewpoint. The other thing I would say, and I would add to that, is when you're out there, putting these deals together, I mean, there's so much more than just, the human relationship side of things. I mean, if you were going to be an operator, you have to go out there and build those relationships with those brokers. You have to go out there and analyze these properties. You have to go out there and tour these properties and put the whole, kind of find a deal, right? So there's a lot more that's involved. So it's good for you to focus on one side of it and to run with it, right? So I like that. I like that. So, yeah.
To that point, I'm sorry, Juan. Yeah, to that point, I would add that I'm a strong believer in teams. I believe that people work much better and much faster and much more efficient when they're a team. And the team can be a team of 2, a team of 3 or 4. It doesn't really matter. But as long as the duties and responsibilities are split, people can perform much better when they have that narrow focus, if you will, where they know they need to concentrate on this area only, and they don't have to spread themselves too thin and go in multiple directions at the same time. It also helps when we want to take a break. Let's say there are 3 partners and one of the partners decides to take a break. While one of the partners taking a break, the other 2 can stay up and watch out for the fourth. But without the benefit of having multiple team members on a team, I think one-person teams always suffers, in the sense that, yes, the one person can work alone, but at the end of the day, they're going to burn down themselves and they're not going to be able to do a great job in the long run. That's just my approach.
That's a very good point as well. It helps to kind of diversify the team a little bit, and you're not all focusing on one specific area, right? So everybody has their strengths and weaknesses, and you can kind of complement each other that way. So, so let's talk about your business plan. Let's go back into that. Let's talk about your business plan, and you did kind of touch on that as well. What type of properties are you focusing on? What markets? And so let's talk about that right now.
Sure. So originally, just like everyone else, or I would say majority of folks, I started with multifamily just because it's close to home and everyone can understand that. I myself once lived in apartment buildings for many years in the past and can definitely relate to that. And then I know a lot of folks have also at some point in their life, whether during college years or early after the college, lived in apartment buildings. That's why people can relate to multifamily investing. That's kind of easier to understand. And in terms of choosing the market, let's just stick to multifamily. I try to choose the markets that are more or less bread and butter, if you will. In other words, I will not go into the hoods, but by the same token, I'm not going to go into luxury neighborhoods where the buildings have all variety of services, including the movie theater and other stuff you can think of. I try to go into the neighborhoods where the working class lives, where I know the people are going to live even if they have some downturn in the economy. Even if the economy is bad, people will still need a place to live, have a roof on their head, and will continue paying for their apartments. That's just my approach to finding an investment, just because as a former tax accountant, I'm very conservative by nature. And I share that with my investors as well, that if there's anyone who is a bit more aggressive or a lot more aggressive, and that their strategy doesn't resonate with mine, I always suggest them to look someplace else. But I share my strategy with my investors, and if it fully aligns with theirs, I would definitely welcome them to be part of my club and work with me. I'm more than happy to help anyone who has the same ideas about the investing plans as I am. Aside from that, as I was investing with my investors into multifamily assets, I was gathering feedback from the investors, and I realized that people were looking to diversify further. So we took a step one by diversifying out of Wall Street and investing into multifamily. You invest in 1, 2, and so forth assets. But then at some point, some folks want to diversify even further. So I started doing research to see what other assets would offer safe, or to some degree safe investing. I mean, there's nothing completely safe or FDIC insured other than the 1% CD that's offered for 2 or 3 years. But in general, as far as the assets that are more or less safer and can sustain poor economy, I discovered storages. Storages is one of those assets which people tend to use a lot, especially when there are downturns, because what people do first when there's a downside in the economy, they tend to sell their houses and move into apartments or smaller houses. And at that time, most folks don't want to get rid of their belongings, so they want to store it until much, much later, where they believe they'll be able to move back into a larger place. And that storage becomes a huge opportunity during the downturns because folks start to use it exponentially more during the downturns in the market. And then after the storage, my next asset that I added to my portfolio was mobile home parks. Again, people were looking for diversification. I was looking for a more or less conservative asset. And what I found with mobile home parks is in the areas where the real estate is extremely expensive, it's really hard to find a decent place, especially for families, and be able to afford it. So mobile home parks provided such opportunity. And when I'm saying mobile home parks, I'm not talking about a place that looks like it's going to collapse, in the next minute or so. We're talking about a very modern homes. The only difference is that they're a lot more compact than the apartments, and that's why they're offered at a lot more affordable price for families that have kids to be able to live in them. And a lot of folks that want their kids to go to decent schools find mobile homes as a great option, because they can live in an affordable place like mobile homes and be able to send their kids to good schools. And that's why, they feel good that they're living in a good community, kids are going to good schools, and they don't need to worry that they will not be able to afford the place because mobile homes offer such affordability.
Yeah, so when you said those mobile home parks, you're not talking about a trailer park. Just to clarify, you're not talking about a trailer
Absolutely
park.
not. Yeah, absolutely not.
Yeah, no, that's good. So basically, what you're doing is you're looking at workforce housing. You want to be in areas where there's workforce housing and markets that can sustain as well. And in states like like a Texas, like a Florida, some of these
Arizona, absolutely.
Arizona, yeah, some of these states where it's attractive. The laws also are attractive. As far as for the landlords as well. So I like that diversification. And so from an investor standpoint, if I'm an investor and I'm thinking, okay, what asset class can I invest in that can also be semi-resistant, for lack of a better word, or resistant during a downturn? And really all three of these that you mentioned are really beneficial. Multifamily has been around for the longest. People always need a roof over their heads. Storage units. Storage units is one of those asset classes where, when I think about it, there's a lot of benefits to it, because when you do have a recession, like you mentioned earlier, what do people do? They move out of their houses and they put all their belongings in storage units. So when you have a recession, that's when they flourish even more. They're doing really, really well. Mobile home parks, it's one of the most affordable asset classes out there for the tenants, and so that's another really good one. So, I like those three asset classes, and from an investor standpoint, I can see how beneficial they can be, to diversify in all three of those.
Absolutely.
Yeah. So that is your business plan, is to help others, be in these different type of asset classes, and to help them preserve their wealth or increase their wealth, in both of those. So what about any other asset classes? Are these the only three that you're focusing on today, or do you have any others that you'll be looking into later? I mean, which others?
Absolutely. I always look at other asset classes to see if there are any potentials to be added to our portfolio to help investors diversify further. Right now, I'm researching senior facility, residential assisted living, and other senior type of facilities. I haven't added that to my portfolio yet, but I try to take the time to do the research upfront before I decide to move forward and add new asset class to our portfolio and allow investors to diversify into it further. So that's something that's been in the works for me, and I plan to complete that by early 2019 to decide whether that's going to be another asset class that will be added to our portfolio and help investors diversify. But again, if it's not senior living facility, it will be student housing, or it will be offices or something else that I'll be looking at to see whether it's potentially an asset that we can add and help investors diversify further.
Got it. Okay, so let's talk about the partners that you're working with. Okay, I want to kind of focus on that as well, because I think it's important for everybody to know the kind of people that you're working with as well, right? So who are the partners that you work with? You don't have to name any names, but what kind of experience do they have, and what's a partner that you would not, or somebody that you would not work with, and what is, describe somebody that you would work with. Kind of go into that a little bit.
Sure. So I think if I'll describe you who I would work with, the opposite would respond to the other question, who I would not want to work with. So what's important for me, first and foremost, is integrity, transparency, track record, professionalism. By dealing with the partners ahead of time before we go into investment, I can tell whether they will be professional enough and whether they will take stuff seriously and whether they will be someone who my investors would want to work with. To me, it's very important that there's a full transparency, that the investors and the investors' money are treated as partners' own money. So I look at that. Track record is obviously extremely important as well, and I know everyone is looking at that. But besides the track record, personal record is important. So I'll give you an example. When I initially decided to invest in syndications as an equity partner, I did my own research, and again, having an accounting background kind of gives me that advantage of knowing how to do the research. And one of my favorite tools is Google. It's a beautiful thing. I mean, you can find anything and anyone you want to. So I would go on Google and literally look at the partner's profile, look at their background. I would look at their education, families, whatever I could find, either through Google or through the social networks, just to see what they're about, what's their personalities, what are they posting on social networks, and whether the material that's posted is professional enough, whether this person has the integrity that I'm looking for. And beyond that, when we were going to the next phase, I would look at their investments and the approach to investments. I would look at the underwriting that we're doing for the property. I would look at the market. When I look at the market, again, I'm looking for the markets that are bread and butter. I don't want to step out of that comfort zone, if you will. I wouldn't go into properties where I would personally be afraid to walk around the property at night, or I wouldn't go into property that are too luxurious and people would probably run away during the recession times and wouldn't be able to afford that. If it's a regular working working class property where everyone would want to live. It's in a decent neighborhood, it's in decent conditions, or it has value add potential. That's something that I would consider. And the same approach would apply to the underwriting. When I look at my partner's underwriting, I look for the conservatism. So some of the signs of aggressiveness in underwriting, if you will, if I see the underwriting and let's say the vacancy rate for the area for multifamily is 3%, and that's what the partner is putting, I would definitely red flag this. You know, I wouldn't want them to put 3% for every single year. I understand that they can change that vacancy to be lower down the term when we're at, say, year 3, 4, and 5. But at the very beginning, when the property is taken on, especially if it's a significant value add property, I expect the vacancy rate to be much higher, to be, let's say, 15 to 20%, and then gradually go down. The same signs I would look for on the expenses line. If I see that expenses are not changing at all, or are exactly the same as that of the sellers, then I would question that. That would be a red flag to me. The expenses should also be changing gradually, and I would want to see the cushion in the expenses. I would want to see the cushion in the property taxes. Granted, the property taxes are an estimate when it's initially purchased from the seller, but even with that, it's supposed to be on the higher side based on the state rate, but it should reflect the potential hike that it will have at the beginning, and I want the underwriting reflect that. So things like that allow me to see the strategy behind the deal sponsors, and allow me to determine whether the deal sponsor strategy resonates with my strategy and my investor strategy, and whether it's something that will resonate with my investors, and whether it's something that we want to take on. Yeah, I hope that answers your question.
Yeah, that was a really detailed answer. So I like that. It was really good. Another one that you didn't say right now, but I know that you also look at it, is the reversion cap. Just make sure that the reversion cap is conservative on the back end, right? You don't want to have a deal where you're buying it for a 5.5, and then your exit is also a 5.5. You want to have a little bit of a cushion there, just in case there's a little softness in the market, right? So that's
definitely.
Yeah. So let's say I want to be a sponsor or a syndicator, kind of like yourself, and raise capital. Let's say I want to be, help others diversify their portfolios and partner up with some very experienced sponsors out there. What is something that I should do to kind of get that kickstarted and to build my own network and, to be able to, get into deals kind of like yourself? What should I do?
Sure. So I would say my case was slightly different from everyone else. I had an advantage due to my education in accounting and MBA in finance. But in general, if someone wants to start out, I think education is the key. So number one, I would start with educating yourself in the areas of syndication, learn all the terminology, read as many books as possible. Number one book that I recommend to everyone is Jim Trowbridge. I believe it's called It's a Whole New World, but it's the foundations of syndication. So that's what everyone should start with. Aside from that, listen to podcasts like the one you have in that provide an overview and feedback from experienced sponsors that people can later reach out to and possibly ask questions and talk to them. Also, networking is extremely important, offline and online. Networking with people at the local REI meetings and networking with people virtually is very, very important. And actually, to that point, I wanted that networking to be expanded to people outside of syndication. So what I did, I started 2 local meetups. Two, because I live in northern New Jersey, which is bordering with New York City. So one of my meetups is in northern New Jersey, the other one is in New York. And we offer the networking experience to people not only within the syndication worlds, whether they active or passive investors, but also to other real estate investors. And what it does is it widens people's horizon. And let's say someone is flipping houses right now, but as they come to our meetups, as they listen to presenters, as they hear others talk, they realize that flipping houses for a long time is not sustainable. Plus, it's ordinary income that for people that are working is basically going to be taxed at their W-2 rate.
Mm-hmm.
And for someone in a higher tax bracket, it's definitely not advantageous to be given back to Uncle Sam 30 to 40% of their income.
Mm-hmm.
So, and then they start thinking to themselves, maybe I need to switch from flipping houses to buy and hold. And if the bandwidth doesn't allow them to be active, at least they can use the income that they produce from flipping houses and passively invest in syndications and be passive investors. And another way to learn, just to add to the initial proposal that I made, is by investing in syndications as an equity partner, because what it gives you is it gives you a backdoor into the syndication world. So you can see what the deal sponsors are doing, what kind of plans they're putting together, how they're implementing their plans, what kind of documentation is used for syndications. And as an equity partner, as a limited partner, you are entitled to ask questions and get the answers. So you can ask questions the syndicators as to what each of the terms mean, how to interpret that, what are the expectations from the partnership, what kind of plans they're putting together. So through that backdoor, you're also indirectly learning the process of syndications. And by the same token, you're making some money on the side. So it kind of kills two birds at once, if you will.
Yeah, and you said that you are a tax or a former tax accountant. So the other thing is you're able to save on taxes as well. It's a big tax advantage as well, to invest in real estate.
Yep.
So I like that, Alina. So what makes the majority of your investors, like, are they more accredited? Are they more sophisticated? What's your focus there? And, how did you build your network? I know you mentioned, the standpoint of education and as well as investing passively. What is something else that they can do, that folks out there can do to kind of build their network after they do these two things as well?
Sure. So building network, just like finding a deal, it requires multiple things. It requires a track record, it requires knowledge, and it requires you to be in the know and letting other people know what you're doing. The most natural way for everyone, and that's the way I started with my own friends and family network. And the idea is to bring together as many accredited investors as possible. And for some people that are already investing just too tired or don't have the bandwidth to do it on their own, to give them further education and explain to them how the process works. And for other people, it's to start out from the very beginning. And in terms of education, what I offer is I partner up with the companies that offer self-directed accounts, such as either self-directed IRA with a custodian or solo 401k or checkbook control IRA. And we do educational webinars where we explain to folks how can they establish such accounts, depending on the qualifications as to which account they qualified for, and how to leverage the funds in these accounts to later invest in syndications. And it really comes down to follow the process and just connecting with me and the other webinar presenters and just starting out on their way of opening up various types of self-directed accounts and then investing these funds in syndications and then watching their investments grow. So that's one of the most natural ways to do it. And then by constantly talking to other people, explaining to them the power of passive investing. Because like I said, I talked to a lot of busy business owners at my local Chamber of Commerce meeting and at other local events and virtual events, and a lot of folks are saying that they are either too scared of Wall Street or too tired to see it go up and down all the time, and it feels like throwing a dart in the dark because stock market keeps fluctuating and going up and down all the time. So at that point I would explain to them what I do and how real estate investing is different, and how the process is really managed by the general partners and limited partners, while having no liability whatsoever, are able to reap the rewards of the partnership by being a partial property owner, and as you said, have the tax benefits of being part of the syndications without doing any work. So if you look at the returns, yes, some people may say, or the IRR is on the so and so, but if you take that IRR or the cash return and look at the amount of time you as a limited partner spend on syndication, you'll see that the returns are really exponential, because the only time you need to spend on a syndication is to review the documentation that offered to you upfront about the investment. And however that may take, I don't know, 10, 20, 25 hours for some people, if you divide the money you bring into the investment over the time you spend on that investment, you'll see that your returns are really exponential, and it's working out for you while you sleep. It really resonates with the Warren Buffett investment. I mean Warren Buffett expression. I don't remember the exact terms, but something to the extent that if your money are not working for you while you're asleep, you're going to be working till the day you die. So that's why it's extremely important not rely solely at a single source of income, whether it's W-2 or whether it's your own business, but always think of other sources of income and being able to add those sources of income, whether it's through pension accounts, brokerage accounts, or real estate accounts, and always think of diversification. It's very important to diversify because it helps you minimize your risks, and in some cases it helps you grow your wealth exponential as well.
Yeah, yes. And that quote is from Warren Buffett is powerful, for sure. It's if you don't find a way to make money while you sleep, you will work until you die. Something to that effect. Yep. And that's something that really, I think everybody should really put on their wall and just think about it. If you're thinking about investing in real estate, then this is something that you really should look at and remember. Because it's a powerful quote. So Alina, I appreciate it. It is time for our nuggets of wealth, and these are questions that I ask every guest every week, and hopefully they are able to help them out. So let's go ahead and get those started. Question number one: what is a good tool, source, or platform that you use almost daily that can also help others?
So there would be multiple tools that I use, but as I mentioned earlier, I think Google is a beautiful thing. I not only use it daily, but I use it many, many times throughout the day for various things. Aside from doing the research on Google, my other tool that I use on a daily basis is my CRM system, customer relationship management system, which is PipeDrive. It helps me keep in touch with my investors. It helps me stay on top of things as to which investors are investing in and what kind of portfolio they help. And overall, it keeps my audience plans and strategies organized, because all of the information about my investors' audience is in my CRM system.
Okay.
So I definitely recommend either PipeDrive or any other CRM that people use. There are many more to use. It really depends on your personal choice.
PipeDrive. Okay, I haven't heard of that one. Okay, got it. What was the best business advice you ever received?
I received and still receiving a lot of good business advice. I guess one of the best things I heard was be authentic, because some people are into acting, a lot, if you will, and they try to play a role. But at the end of the day, it's gonna come out. So someone said, try to be as authentic as possible, and whoever believes and plans resonate with yours will get attracted to you. So I try to be as authentic as possible, and just be myself.
There you go. Yeah, that is very important. And I think, a lot of people, they try to fake it till they make it kind of, out there. And, you are where you are, and, if you really want to, make changes in your life, then you can improve. You can always improve, just be authentic, like Alina said. And I think that's very powerful because it goes a long way, and that's one of the things that, one of the traits that I look for. And I know that Alina does as well. Be authentic, be genuine, be yourself,
Definitely.
What separates yourself from other syndicators?
In my case, I think it's the way I conduct business. I will never offer to anyone to invest into any investment where I would not personally invest myself. So before offering anything to other investors, I would do my own detailed research on a deal sponsor if I haven't worked with them, and then on the investment, and only when I feel confident that this is the type of investment that I believe will sustain recession, I will offer it to my investors. And I always try to invest in every single investment I offer to others, as long as I have the funds available. It's very important. And everyone asks, it's like one of the most common questions: do you have any skin in the game? And of course I want to have skin in the game in every investment where I bring my investors in. So that's what I do.
Good. Okay. Where do you see yourself in 5 years? Where do you see SAMO Financial and yourself in 5 years?
Boy, that's 5 years is a very long time. I would say I do my yearly plans, and for the next year, my plan is to grow my investors base by 30 people every 30 days. I know it's aggressive, I know it's 10x, but I believe in 10x rule. I read Grant Cardone's 10x rule and many other books, and I think when people see my strategy, when it resonates with them, when they see the way I approach business, they will continue coming over as they're doing now, and they will continue referring others as they're doing now.
Got it. Okay, good. Okay, so last but not least, at the end of your life, how do you want to be remembered?
So for that, I would probably want to use the words of the famous writer Maya Angelou. She said, people never remember what you did, and people will never remember what you said, but people will always remember how you made them feel. So I try to make every single person I talk to feel important, regardless whether they decide to work with me or not. I give everything I have, and I share all the information I have, and I try to be as transparent as possible about my approach and about the offerings I'm working on, because to me, it's very important that at the end of the day, the person on the other end felt as that they were the most important client of mine.
Got it. That's a really good one. I like that. Okay. So where can Commit to Wealth Nation go to contact you and find out more about what you're doing in SAMO Financial?
They can go on my website, which is samofinancial.com. They can email me, which is my first name, Alina, ALINA, at samofinancial.com, or they can call or text me at 201-281-7430. And if they didn't catch the number or the email, my contact information is listed on my website. So welcome everyone to contact me or reach out to me either through my website or through social media. I'm on all the social media, available to be contacted anytime.
Sweet. So Alina, once again, it was a pleasure to have you on. I really appreciate you, your advice that you have given us here. For those of you, the guys out there that are looking to raise their own funds, or to invest passively. Alina's a great person. I've talked to her many, many times. So this is not the first time we have spoken, and I can attest to her authenticity as well. So again, I appreciate you being on, Alina, and I wish you continued success.
Thank you, Juan. It's my pleasure. Thank you for inviting me, and thank you for the interview. And I want to thank your audience for listening to this podcast interview. Have an awesome day.
Thank you so much.